Good day. The purpose of this video is to examine the economics of monetary policy. In the United States, monetary policy is conducted by the Federal Reserve. The FOMC has 12 voting members. The 7 members of the Board of Governors all have a voting position on the FOMC, and 5 presidents of the regional banks across the country also sit on the FOMC. The Bank of New York president always gets to participate, and the other 4 rotate out of the remaining 11 regional banks on a yearly basis. The Federal Open Markets Committee, or FOMC, meets every 6 weeks, 8 times a year, to conduct monetary policy. The FOMC can also convene during economic emergencies without a scheduled meeting. The Federal Open Markets Committee has a dual mandate. That is to say, our Federal Reserve watches both unemployment and inflation. It is the job of the Federal Reserve to conduct monetary policy such as to assist the economy in achieving full employment, non-inflationary level of output. It is assumed students have a thorough knowledge of the aggregate demand, aggregate supply model of macroeconomic equilibrium to understand the dual mandate of the Fed in maintaining price level at or near 2% inflation and the unemployment close to the natural rate of unemployment of 4%. Remember, macroeconomic equilibrium measures the amount of real GDP and unemployment on the horizontal axis and the price level inflation on the vertical axis. As pictured on this graph, the economy is in the Goldilocks scenario with real GDP growing at or near 2.3%, unemployment close to that natural rate of unemployment of 4%, and inflation as measured by the CPI real close to 2%. Later, this video will examine the particulars of how our nation's central bank, the Federal Reserve, conducts monetary policy. But it's vitally important to understand the big picture before getting into the details. The Federal Reserve controls the nation's money supply and therefore influences interest rates. As already covered in this course, interest rates are vitally important because they have a huge impact on the level of macroeconomic spending and therefore the level of real GDP, unemployment, and inflation. The interest rate that our nation's central bank targets is referred to as the federal funds rate, or for short, the Fed funds rate. When the Fed speaks, interest rates listen. The Fed influences interest rates that affect our lives, such as the rate on automobile loans, mortgages, credit cards, and student loan debt, by raising or lowering the Fed funds rate. Likewise, when the Fed alters its interest rates, it's going to have a significant impact on gross business investment, affecting the relationship for firms, businesses, companies, when they evaluate that relationship between the real rate of interest and the expected rate of return on business projects. Assume for a moment that the economy is in a recession where real GDP is falling and unemployment is well above the natural rate of unemployment of 4%, let's say in the neighborhood of 7 or 8%. To address a recessionary gap, our nation's central bank will implement what is called expansionary monetary policy. In essence, the Fed will attempt to increase aggregate demand to stimulate consumer and business spending by lowering its target rate, the Fed funds rate, making it easier for households and businesses to borrow, and therefore increasing consumer and investment spending, which in turn will increase aggregate demand, which should stimulate real GDP and start to bring that unemployment rate down towards the natural rate of unemployment. If, on the other hand, the problem is an inflationary gap, demand pull inflation, too much money chasing too few goods, where actual GDP is temporarily exceeding potential GDP, our nation's central bank, the Federal Reserve, will implement contractionary monetary policy. By implementing contractionary monetary policy, the Fed aims to increase interest rates, making it more challenging for consumers and businesses to borrow, therefore stifling household and gross business investment spending, which would in turn decrease aggregate demand, which will slow economic activity and rein in the price level. In essence, this is monetary policy. Again, understanding the big picture is vitally important before moving on to the particulars. Evaluate macroeconomic equilibrium at E2, YP, PL2, full employment domestic output. At this level of macroeconomic equilibrium, real GDP is growing near 2.3%. The unemployment rate is close to the natural rate of unemployment of 4%, and inflation is real close to 2%. Now assume that a stock market crash creates negative wealth effect, or households are worried about the value of their largest asset because home prices are falling, raising household indebtedness, or consumer confidence begins to fall. Likewise, businesses evaluating the economic outlook are pretty negative about the expected rate of return on all projects. These factors will shift the aggregate demand curve from 82 leftward to 81. At our new macroeconomic equilibrium, E1, Y1, PL1, the economy is now in a recession. You can notice the recessionary gap. There is a contraction of real output, meaning the economy is falling short of its potential GDP, causing cyclical unemployment. At this juncture in macroeconomic history, price level is not the problem, but with falling GDP and rising unemployment, what can our nation's central bank, the Federal Reserve, do to assist the economy in returning to full employment domestic output? The proper monetary policy response to a recessionary gap, E1, Y1, PL1, is expansionary monetary policy. This involves our nation's central bank, the Federal Reserve, lowering its federal funds rate, policy rate. A lower Fed funds rate will bring down the interest rate on car loans, mortgage loans, student loan debt, and credit card debt, putting more money in the pockets of households, therefore stimulating aggregate demand. A lower Fed funds rate will also bring down the interest rate on business loans, which will incentivize businesses to borrow and invest, as hopefully now the expected rate of return on new projects is greater than the real rate of interest. If successful, expansionary monetary policy with lower interest rates will stimulate aggregate demand from 81 back towards 82, increasing real output and reducing the unemployment rate back towards the natural rate of unemployment of 4%. Again, evaluate macroeconomic equilibrium at E2, YP, PL2. Full employment domestic output, Goldilocks scenario, real GDP growing at 2.3%, unemployment close to the natural rate of unemployment of 4%, and inflation at 2%. Now, aggregate demand gets excessive. Too much money chasing too few goods. Spending begins to outpace the economy's ability to produce. This happened in 2022 as there was too much fiscal stimulus in response to the pandemic. A rightward shift in aggregate demand from 82 to 81 causes an inflationary gap, demand pull inflation. Evaluate equilibrium at E1, Y1, PL1. Real GDP is temporarily beyond potential GDP. Unemployment rate is below the natural rate of unemployment. But the cost of excessive spending is inflation. The aggregate price level or inflation, 5, 6, 7%. The question then is, how can our nation's central bank address demand pull inflation or a price level, aggregate price level well above target? In response to the inflationary gap at E1, Y1, PLE, the level of macroeconomic equilibrium where actual GDP is temporarily exceeding potential GDP, the unemployment rate is below the natural rate of unemployment, but inflation is getting out of control, say 6, 7, 8%. Our nation's central bank, the Federal Reserve, will implement contractionary monetary policy. This will involve the Fed reducing the money supply to push up the Fed funds rate. A higher Fed funds rate will therefore cause interest rates on mortgage loans, car loans, student loan debt, and credit cards, other interest rates to increase, stifling consumer spending by making it more costly to borrow and spend. A higher Fed funds rate will also push up the interest rate on business loans, which will decrease gross business investment, as now it will make it more difficult for businesses to find projects where the expected rate of return is greater than the real rate of interest. If successful, contractionary monetary policy will start to decrease aggregate demand from 81 back towards 82, reining in some of that inflation, reducing the aggregate price level back towards the desired 2%. After explaining the big picture, it's important to get into the nitty-gritty, the details. Begin our detailed examination of monetary policy by talking about interest rates. What is an interest rate? If an individual institution borrows money, the interest rate is the price paid for the use of that money. However, there's two sides to every economic coin. It is also the return that the lending institution, bank and such, receives for loaning out funds. We speak as if there is only one interest rate. However, in reality, there are many interest rates. On the next slide, we will examine and explain some of the most important interest rates in the economy. Ultimately, interest rates in the economy are determined by the money market, the supply and demand for money. Time for an introduction and explanation of some of the key interest rates in the economy. The discount rate. Our nation's central bank, the Federal Reserve, is sometimes referred to as the lender of last resort. When banks and other financial institutions can't get other commercial institutions to lend them money, they can borrow at the discount window, direct lending from the Federal Reserve. An important feature of the discount rate is that it sets the upper target for the Fed funds rate to ensure that banks are not discouraged from borrowing from each other. We will see this graphically later on in the presentation. Speaking of the Fed funds rate, this one is important. Time for a detailed investigation and explanation of the Fed funds rate. The Fed funds rate is the key policy rate of our nation's central bank. Technically, the Fed funds rate is the overnight lending rate that large financial institutions and government agencies charge one another to borrow currency that is held at one of the 12 Federal Reserve regional banks. When there was a required reserve, banks would need to borrow from each other to meet reserve requirements. Now that there is no longer a required reserve, the Fed funds rate is still vitally important for banks to set their own lending rates and meet regulatory liquidity requirements. The Fed adjusts the Fed funds rate by using the interest they pay on reserve balances. If you want to get extremely technical, there's this arbitrage between the interest on reserve balances and the interest on overnight reserve repos. However, that's a little too technical for an introductory class. We will discuss the interest on reserve balances in grave detail later. The Fed sets the upper and lower bound of the Fed funds rate, targets the interest rate within 0.25, 25% basis points. Again, for introductory students, the most important idea of the Fed funds rate is the policy rate of our nation's central bank, and it is the interest rate that the Fed uses to clearly communicate its intentions on monetary policy. Although it was stated earlier, it's important to reiterate the other important interest rates in the economy take their lead from the Federal Reserve's policy rate, the Fed funds rate. Speaking of some of those other important interest rates, One benchmark interest rate is the 10-year Treasury. Remember, our federal government, Uncle Sam, runs large federal budget deficits. Federal government expenditures exceed tax revenues, forcing the federal government to borrow to finance federal budget deficits. The most commonly issued debt instrument of our federal government is the 10-year Treasury, and the interest rate on the 10-year Treasury is what it costs our nation to borrow funds for 10 years from individuals and institutions. The prime rate. The prime rate of interest is the interest rate banks charge their most credit-worthy customers. If you're a manufacturing firm, you've been in business for 15 years, and you have tremendous credit history, you will borrow at the prime rate of interest. Banks are a competitive lot. You may even be able to borrow at the prime minus 0.25%. The 30-year mortgage rate. Most individuals and households who purchase homes don't pay cash for such a large purchase. Even if they have the cash, it might be a wise idea to finance the purchase of a home. 30-year fixed rate mortgage is the interest rate that individuals and households pay to borrow funds over that time frame to finance a home. 5-year car loan, there's actually 7-year car loans now. How much interest it's going to cost you to buy that new car or to finance a used car. Most of us want to avoid credit card debt, but if it is necessary to take on credit card debt, you're going to pay a high interest on that borrowing from your lending institution. Another important interest rate is the rate on student loans. Again, the Fed funds rate will influence how much it costs graduates to finance their degree. Last but not least, and this is related to the Fed funds rate and will be investigated in more detail shortly, the interest on reserve balances. Post-financial crisis, banks park copious amounts of reserves at the Fed, and the Fed pays interest on those reserves. So therefore, this is a key interest rate and will set the lower bound of the Fed funds rate. Understanding the federal funds rate or Fed funds rate is the most important interest rate in the economy. Probably a wise idea to investigate the history of our nation's central bank's policy rate. This chart tracks the Fed funds rate from 1955 through this year, 2025. When evaluating this time frame, remember the gray areas represent economic contractions or recessions, the downward phase of the business cycle. Also understand there's a correlation between the Fed funds rate and recessions. Every time the economy begins to contract, our central bank, the Federal Reserve, reacts by lowering interest rates in an effort to support the economy, to make it easier for consumers to borrow and spend, and to stimulate gross business investment. For instance, take the recession of the early 90s, 1991. At that juncture, right before the recession, the Fed funds rate was approximately 7.75%. In response to the economic downturn, the Fed lowered its policy rate, the Fed funds rate, from 7.75% to approximately 2.75%. One extremely interesting and important period of economic history to evaluate is the pandemic. Trace the Fed funds rate over to the 2007/2008 timeframe. The Great Recession was caused by financial crisis and simultaneous collapse of the housing markets. In response to this cataclysmic economic contraction, our nation's central bank began to lower its policy rate, the Fed funds rate, from 5% to 4%, 3%, 2%, and eventually reached what is now known as zero bound. Theoretically, when the Fed had lowered its policy rate to zero, it was out of monetary policy ammunition to fight the economic contraction. This forced the Fed to introduce a new approach to monetary policy, referred to as quantitative easing. It's important to point out this phenomena at this juncture in our economic learning because quantitative easing theoretically changed the approach to monetary policy, and this chart allows us to visualize when this happened and why the Fed needed to investigate a unique and novel approach to monetary policy. Things began to normalize several years after the Great Recession, and it appeared as if we were on track to have a traditional Fed funds rate approaching somewhere near 5%. And then the pandemic occurred. And because quantitative easing worked so well in response to the Great Recession, the Fed once again revisited this unique tool of monetary policy. Again, it will be investigated in more detail soon. More recently, 2022, our nation experienced significant inflation. The CPI rose to 9% in 2022, forcing the Fed to implement contractionary fiscal policy in response to runaway aggregate price level. This can be seen towards the end of the chart where the Fed funds rate was raised from the near zero level that was the COVID policy level to slightly above 5% by 2023. This chart tracks the correlation between the Fed funds rate and the M2 money supply from 1955 through 2025. On the chart, the blue line represents the M2 money supply and the red represents the Fed funds rate. This chart demonstrates an important correlation between the money supply and interest rates and intended Fed policy. Understand, when the Fed wants to combat inflation, it does so by raising interest rates. To raise interest rates, the Fed reduces the money supply. Notice the period of time in U.S. economic history in the late 70s, early 80s, approximately in the middle of this chart. During that period, the United States was experiencing annual increases of the CPI inflation over double digits. To combat double digits inflation, the Fed reduces the money supply, thereby increasing their policy rate, the Fed funds rate. In 2007, the beginning of 2008, the United States experienced a severe economic contraction referred to now as the Great Recession, caused by the simultaneous collapse of the housing market and the financial crisis. In response to that economic downturn, the Fed desired to lower its policy rates. In order to lower its policy rate, the Fed introduced copious amounts of liquidity or money into the economy. Notice in 2008, the Fed funds rate falls from over 5% down near zero, while the money supply increases. This correlation can be observed significantly during the pandemic. During the pandemic, the United States had to involuntarily shut down large swaths of the economy, especially the hospitality and services sector. During this time, the Federal Reserve lowered its policy rate to zero and noticed the significant increase in the money supply. So again, remember, when the economy is in a recession, the Fed wants to lower interest rates. The Fed lowers interest rates by increasing the money supply. And if the economy is dealing with inflation, the Fed wants to increase interest rates. And to increase interest rates, our central bank reduces the money supply. When the Fed speaks, interest rates listen. When our nation's central bank, the Federal Reserve, alters its policy rate, the Fed funds rate, it influences the other important interest rates in the economy, which therefore affect economic activity. This chart demonstrates the cause and effect relationship between the Fed funds rate and other important interest rates. Notice that from 1964 through 2011, whenever the Fed raises its policy rate, the Fed funds rate, on this chart outlined in blue, the other important interest rates follow suit. When the Fed raises its policy rate, the prime rate, which is the rate banks charge their most creditworthy customers to borrow funds. The 5-year Treasury and the 10-year Treasury also increase. And likewise, when the Fed lowers its policy rate, those other important interest rates follow the leader. This chart demonstrates the relationship between Federal Reserve monetary policy actions and household spending as it tracks the relationship between the Fed funds rate and the 30-year fixed rate mortgage. Most individuals and households who purchase a home do so by financing it through a loan, and the most common loan is the 30-year fixed rate mortgage, where individuals or households put a down payment on a house and pay back the remaining principal over 360 months at a fixed rate. Notice the correlation between the Fed funds rate and the interest rate charged by banks for individuals and households who finance their home. On this chart, the blue line tracks the Fed funds rate from 1970 through 2025, and the red demonstrates the interest rate on a 30-year fixed rate mortgage over that same time frame. In the 1970s, when inflation was plaguing the U.S. economy, the Fed responded by increasing its Fed funds rate, pushing the interest rate charged for home borrowers all the way up above 17.5%. During the 2008 financial crisis and the ensuing Great Recession, the Fed lowered its policy rate to near zero, pushing down interest rate on 30-year fixed rate mortgages below 4%. This chart demonstrates the direct impact the monetary policy actions taken by the Fed have on household spending. Before examining the balance sheet of the Federal Reserve, it's necessary to review the fundamental accounting equation: assets equal liabilities plus shareholders' equity. From 1950 through 2008, explaining the balance sheet of the Federal Reserve was a rather straightforward process. What were the assets of our nation's central bank, the Fed? First, Treasury securities, government bonds of short-term maturity. Second, loans to commercial banks. That is to say, when the Fed serves as the lender of last resort and loans funds to commercial banks, these banks owe the money back to the Fed. Therefore, those loans are an asset of the central bank of the United States. What about liabilities of the Fed? What does the Fed owe? Banks would park reserves at the Fed. These reserves, obviously, the property of commercial banks, therefore a liability to the Federal Reserve. Second, Treasury deposits. Remember, the Fed serves as the fiscal agent of the federal government. In layman's term, Uncle Sam has a checking account at the Fed where our federal government can deposit tax revenues and write checks such as federal disability checks, Social Security checks, unemployment checks, yada, yada, yada. Last and definitely not least, Federal Reserve notes outstanding. Think if you're playing the New York Times Sunday crossword puzzle, a 4-letter word for Federal Reserve notes outstanding: cash, cash in circulation. Remember, a balance sheet is a snapshot, a picture of a point in time of the financial position of an institution. This represents the balance sheet of the Federal Reserve in February of 2008, right before the financial crisis and housing bubble burst, completely altering the Fed's approach to monetary policy. Assets owned by the Fed in February of 2008: securities, short-term maturity treasury bonds issued by the federal government. Prior to the financial crisis, our nation's central bank, the Fed, conducted monetary policy largely by buying and selling government bonds. This action is known as open market operations. As explained on the previous slide, another asset of the Federal Reserve: loans to commercial banks. When banks borrowed from the lender of last resort at the discount window, These monies are owed back to the Fed, therefore an asset of the Fed. All other assets, simply this is the land and other assets owned by the Federal Reserve. In total, Federal Reserve assets prior to the impact of the financial crisis, $885 billion. Keep that number in mind. The balance sheet of the Federal Reserve was less than $1 trillion prior to the financial crisis. What were the principal liabilities of the Fed prior to the financial crisis? Notice that a small amount of reserves were parked at the Fed, $11 billion worth prior to the financial crisis. Commercial banks depositing money at the Fed. Treasury deposits, again, money deposited by Uncle Sam because the Fed acts as the fiscal agent for the federal government. But most importantly, notice Federal Reserve notes outstanding, aka cash in circulation. When you evaluate the left-hand side of the balance sheet assets relative to the right-hand side of the balance sheet liabilities, the Treasury securities owned by the Fed, government bonds that the central bank owned, were almost equally offset by cash in circulation. Remember when we studied money, the idea that all money is debt and cash in circulation is literally debt offered by the Central Bank of the United States. Let's revisit this chart of the Fed funds rate to explain how and why the balance sheet of the Federal Reserve fundamentally changed in response to the 2008 Great Recession. The financial crisis and housing bubble burst caused an economic contraction unlike any other. It was not your garden variety recession. Initially, the Fed responded to the economic downturn with traditional monetary policy, reducing its policy rate, the Fed funds rate, from 5% in late 2007 all the way to 0. At this juncture in 2009, the Fed reached what is now referred to as the zero bound. Theoretically, our nation's central bank was out of monetary policy ammunition to combat this severe economic contraction. It was at this juncture that the Fed decided to introduce a new tool of monetary policy, quantitative easing, in an effort to support the U.S. economy during a severe economic downturn. So what is quantitative easing? When the Fed had reached that zero bound, it introduced a unique tool of monetary policy, quantitative easing. This involved the Federal Reserve purchasing long-term treasury bonds, so government bonds of long maturity, and mortgage-backed securities. Mortgage-backed securities referred to mortgages which had been packaged together and sold off as financial instruments. They were popular among investors from the late 90s through 2007 as they offered high interest rates. But when the housing bubble burst, the market value of these mortgage-backed securities plummeted. So our nation's central bank purchased copious amounts of long-term treasury bonds and mortgage-backed securities, first in response to the 2008 financial crisis. Then when the economy needed to be voluntarily shut down, or at least parts of it, because of the pandemic, the Fed once again engaged in this quantitative easing approach to monetary policy. It is important for students to understand that before 2008, neither long-term government debt nor mortgage-backed securities existed on the Fed's balance sheet. The Fed engaged in 4 rounds of quantitative easing in response to the financial crisis. This expanded the balance sheet of the Fed from under $1 trillion, $869 billion, to $4.4 trillion. Then in response to the pandemic, the Fed more than doubled the size of the balance sheet by engaging in copious amounts of quantitative easing, expanding the Fed's balance sheet to over $9 trillion. Most economists agreed that this unique and novel tool to monetary policy, quantitative easing, rescued the economy from another Great Depression in the 2008 post-Great Recession era and was tremendously helpful to supporting the economy through the pandemic. However, like all things economics, there's always a cost. One of the huge questions after such enormous amounts of quantitative easing was how will the future economy be affected by the inevitable quantitative tightening? When the Fed purchases long-term government securities and mortgage-backed securities, eventually the duration of those bonds will expire, and if the Fed doesn't purchase more bonds, inevitably the size of the balance sheet will shrink. No one in the financial or economic community had any idea about how this inevitable quantitative tightening will affect the economy, and the answer is still playing out in 2025. Last, definitely not least, the massive expansion of the Fed's balance sheet in first response to the financial crisis and later the pandemic fundamentally changed or altered the approach that our nation's central bank, the Federal Reserve, uses to conduct monetary policy. In essence, it was the transformation from a limited reserves model to what is now referred to as the ample reserves model. This chart reveals the initial effects of quantitative easing and displays the fundamental changes to the Fed's balance sheet that began to occur in response to quantitative easing. Notice that in 2005, we even saw in 2008, the Fed owned zero mortgage-backed securities and earned zero amount of federal agency debt securities, in other words, long-term government debt. However, by 2010, the Fed owned nearly $1 trillion worth of mortgage-backed securities and nearly $200 billion worth of long-term government debt. This Bloomberg chart from May of 2022 illustrates the impact of quantitative easing on the Fed's balance sheet, where the dark blue represents mortgage-backed securities, the orange represents government debt purchased by the Fed. After 3 rounds of quantitative easing in response to the 2008 financial crisis, the balance sheet of the Federal Reserve expanded from approximately $870 billion to over $4 trillion. Then once again, in response to the 2020 pandemic, the Fed engaged in copious amounts of purchases, long-term government debt, mortgage-backed securities, quantitative easing, expanding the Fed's balance sheet to an unimaginable over $9 trillion. To explain the effects of quantitative easing on the Fed's balance sheet, let's take a closer look at the Fed balance sheet from 2002 through 2025. For the longest stretch, late 1960s through 2008, the size of the Fed's balance sheet remained relatively stable at somewhere near $800 billion. Then in response to the financial crisis and the Great Recession, the Fed began to engage in this new program of quantitative easing when it had reached that zero bounds, 0% interest on the Fed funds rate. The Fed began purchasing large amounts of mortgage-backed securities and copious amounts of long-term government debt. After several rounds of quantitative easing, the size of the Fed's balance sheet expanded from under $1 trillion, more than fourfold to above $4 trillion. Notice that in 2018-19, the size of the balance sheet began to normalize. This idea of quantitative tightening, the maturity of the long-term government debt and mortgage-backed securities began to expire, and naturally the size of the Fed's balance sheet began to shrink. Then the pandemic hits. What worked for the Great Recession was then attempted to alleviate the economic worries of the pandemic. The Fed engaged in even greater amounts of quantitative easing, purchasing enormous amounts of long-term government debt, mortgage-backed securities, and other securities, pushing the size of the Fed's balance sheet above $9 trillion. Notice again towards the end of this chart, as it approaches the now time of 2025, that again, this natural phenomena of the maturity of the long-term government debt and the mortgage-backed securities is beginning to be reached. In other words, the size of the Fed's balance sheet is automatically experiencing quantitative tightening. There is a huge economic debate as to how quantitative tightening will ultimately affect the economy. After providing a general overview of monetary policy, now it's important to explain the details of what tools the Fed uses to manage the Fed funds rate, the policy rate of our central bank to conduct monetary policy. Understand there are two distinct periods of monetary policy. From 1950 through 2008, pre-financial crisis, a regime of limited reserves. During this period of time, the Fed used three tools: the required reserve ratio, the discount rate, and primarily open market operations to adjust the Fed funds rate. Post 2008, post financial crisis, now the Fed is engaged in what is referred to as a regime of ample reserves. In the ample reserves regime, the tools of monetary policy include the possible use of quantitative easing, which is glorified open market operations; forward guidance, which is in essence the Fed announcing to the financial and economic community its intentions on monetary policy and the Fed funds rate; and then the most important of the current Fed tools, the administered rates, the use of the discount rate and interest on reserve balances to adjust the Fed funds rate. Let's take a closer look at the limited reserves framework, or the period of time from 1950 through 2008, to explain the three tools of monetary policy prior to the Great Recession. The first tool of monetary policy used by the Fed to manage the policy rate, the Fed funds rate, was the required reserve. Remember, the Fed has the legal right to require banks to hold a certain percent of checkable deposits, bank customer deposits, on reserve. From 1950 through 1992, the required reserve ratio was 12%. From 1992 through 2020, the required reserve ratio was 10%. Obviously, this was a rarely used tool of monetary policy because it had what is known as the double whammy effect. If and when the Fed adjusts the required reserve, it automatically affects the amount of excess reserves that banks hold, and it affects the size of the money multiplier, so it was always referred to as the most powerful tool of monetary policy. The second tool at the disposal of the Fed to manage its policy rate, the discount rates, the interest rate that the Fed charges commercial banks to borrow from the lender of last resort at the discount window. Although these two tools were readily available to the Fed prior to the financial crisis, most of the time, meaning 98% of the time, the Fed used open market operations to conduct monetary policy. The Fed largely affected the amount of excess reserves that banks were holding, and therefore the money supply, by buying and selling government bonds. Because it was the most widely used tool of monetary policy prior to the Great Recession, it's important to explain open market operations in more detail to therefore explain how the buying and selling of bonds affects the money supply and interest rates. Assume the economy is in a recession. Real GDP is contracting. Unemployment is beginning to rise well above the natural rate of unemployment, so the economy is experiencing cyclical unemployment. To assist the economy back towards full employment domestic output, to kickstart aggregate demand, the Fed wants lower interest rates to stimulate consumer borrowing and spending, and businesses borrowing and spending on investments. machines, equipment, tools, factories, new projects, and such. How does this work? In this scenario of a recessionary gap, the Fed buys government bonds, banks get the influx of cash, the Fed gets the bonds. The influx of cash now represents new reserves deposited at banks. This will increase the money supply, and an increase in the money supply, as we saw graphically on the money market, will then cause interest rates to fall. Lower interest rates stimulate consumer borrowing and spending, and businesses borrowing and spending. If, on the other hand, the economy is experiencing inflation, that inflationary gap where real GDP was temporarily exceeding its potential level of outputs, so actual GDP temporarily above potential GDP, demand pull inflation, too much money chasing too few goods, to rein in the spending, to curb aggregate demand, the Fed wants to raise interest rates. How does it perform open market operations to raise interest rates? The Fed would sell bonds to banks, soaking liquidity out of the system. The money supply decreases, raising interest rates. Higher interest rates will stifle some consumer spending and some gross business investment, shifting aggregate demand to the left and hopefully reining in some of that inflation. Let's now explain mathematically what was introduced anecdotally in regards to open market operations. Assume the economy is in a recession, contracting GDP, rising unemployment. The Fed wants to stimulate aggregate demand by lowering interest rates. Observe the balance sheet of a typical bank on the left-hand side on this chart labeled before. Currently, this bank was holding zero excess reserves, so is in a position to create no new monies, no new loans. But the bank owned $1 million worth of bonds. Along comes the Fed and purchases these bonds using open market operations. The Fed buys the bonds. Notice on the right-hand side, the after balance sheet. Now the bank is no longer holding any bonds, zero, but they're holding $1 million in excess reserves. So when the Fed purchases treasuries, they increase the money supply. This puts new excess reserves in the hands of banks. Banks are now able to lend out these excess reserves, which increases the money supply, bringing down interest rates, which would stimulate consumer and business borrowing and therefore aggregate demand. Now assume the economy is plagued by an inflationary gap. Actual GDP is temporarily exceeding potential GDP. The price level is well above the 2% target. Inflation in the neighborhood of 6, 7, 8%. GDP and unemployment are not the problem. To address this demand pull inflation, too much money chasing too few goods, the Fed will engage in open market operations, in this case, selling bonds to bank. Again, observe the before and after balance sheet of the typical bank. Before the open market operations, this bank was holding $1 million in excess reserves and owned zero bonds. Along comes the Fed and sells bonds to the bank. The bank takes the $1 million in excess reserves, hands it over to the Central Bank of the United States, the Federal Reserve. Now the bank has no excess reserves but owns $1 million in bonds. The money supply has now decreased. So using open market operations to combat demand pull inflation, the Fed sells treasuries, decreasing the money supply. This will reduce the amount of excess reserves in the banking system, therefore reducing the overall money supply, pushing up interest rates, which would slow consumer borrowing and spending, slow business investment, borrowing and spending, and therefore decrease aggregate demand. It is necessary to examine how the three tools of the required reserve, the discount rate, and open market operations affected the domestic money market under a limited reserves framework. If the Fed lowered the required reserve ratio, lowered the discount rate, or bought bonds in open market operations, there would be an increase in the money supply, decreasing interest rates. If, on the other hand, the Fed increased the required reserve ratio, increased the discount rate, or sold bonds in using open market operations, there would be a decrease in the money supply, leading to an increase in the Fed funds rate. Assume the economy is in a recession. Actual GDP is falling well short of potential GDP. Cyclical unemployment. Actual unemployment is well above the 4% target, 7-8%. No upward pressure on prices. Inflation is well below the 2% target. How can our nation's central bank, the Federal Reserve, address this recessionary gap in an effort to stimulate aggregate demand back towards full employment domestic outputs? The Fed has three tools at its disposal under the limited reserves framework. The Fed could use the rarely implemented required reserve ratio, lowering the required reserve, which would automatically increase the amount of excess reserves that banks hold and increase the size of the money multiplier. The Fed can lower the discount rate, making it easier for banks to borrow from the Fed, the lender of last resort, at the discount window. Most likely, the Fed will use the most widely adopted tool of monetary policy under the limited reserves framework. The Fed will buy bonds from banks. This expansionary policy, open market operations, will increase the money supply, adding excess reserves to the banking system. These new excess reserves will be loaned out. The increase in the money supply will reduce interest rates. Remember, lower interest rates stimulate consumer borrowing and spending and make it more enticing for businesses to borrow, as now lower nominal interest rates makes more business projects where the expected rate of return is greater than the now lower rate of interest. Now assume the economy is dealing with an inflationary gap, too much money chasing too few goods, aggregate spending outpacing the economy's ability to keep up with production, actual GDP temporarily exceeding potential GDP, the unemployment rate below the natural rate of unemployment, but inflation 6, 7, 8%, well above the 2% target. How can the central bank, the Federal Reserve, use its tools under a limited reserve framework to address this inflationary gap? The proper monetary policy is referred to as contractionary monetary policy. The Fed is actually trying to reduce aggregate demand to rein in some of that inflation to reduce the aggregate price level. Under a system of limited reserves, the Fed could increase the required reserve ratio, a rarely used option. The Fed could raise the discount rate. Most likely, the Fed's going to perform open market operations. That is to say, the Fed will sell bonds. When the Fed sells bonds, it soaks excess reserves out of the banking system. Reducing the money supply pushes up interest rates. Higher interest rates make it more difficult and costly for consumers to borrow and spend. It makes it more challenging for businesses to find projects where the expected rate of return is greater than the real rate of interest. Therefore, the reduction in consumer spending and gross business investment will shift aggregate demand leftward, hopefully reducing some of that demand pull inflation. This chart tracks the amount of bank reserves deposited at the Fed from 1960 through 2025. Notice the two distinct periods of time on this chart. From 1960 through 2008, the flat line, the amount of bank reserves deposited at the Fed barely budged, and it was barely eligible on this chart. Over that nearly 50-year time frame, the amount of bank reserves deposited at the Fed was somewhere between $20 and $40 billion. Sounds like a large amount of money to you and me, but considering the enormity of the U.S. economy and the banking system, relatively speaking, not all that much. Then, in response to the Great Recession, the Fed begins to engage in quantitative easing, purchasing copious amounts of mortgage-backed securities and long-term government debt. The Fed bought these financial instruments from banks and other financial institutions. Where did the cash end up being deposited? You guessed it, at the Fed. Notice the enormous increase in the amount of bank reserves deposited at the Fed, first in response to the 2008 financial crisis quantitative easing program, and then again the quantitative easing that occurred during the pandemic. This increased the amount of bank reserves from around $40 billion prior to the Great Recession to over $4 trillion when it was all said and done in response to the pandemic. This enormous increase in the amount of bank reserves deposited at the Fed fundamentally caused the Fed to reevaluate how it conducts monetary policy. In essence, quantitative easing forced the central bank of the United States, the Federal Reserve, to completely change its approach to conducting monetary policy. From 1950 through 2008, basically post-World War II until the financial crisis and Great Recession, the central bank operated under a limited reserves framework. Notice the graph on the left resembles the money market studied thus far, where equilibrium in the money market occurs in the downward sloping portion of the demand curve, and the Fed funds rate is determined by the intersection of the supply of money and the demand for money. Then, beginning with the first round of quantitative easing in response to the financial crisis, and after several rounds of quantitative easing, the amount of reserves parked at the Fed increased from about 46 billion to nearly 4 trillion. So when the amount of bank reserves deposited at the Fed increased by more than tenfold, the entire framework of monetary policy changed to the new system of ample reserves. On the graph on the right, you will notice that the supply of reserves now intersects with the demand for reserves in what is referred to as the horizontal range of the demand curve. On the next slide, we'll explain the three segments of the demand for reserves and further explain how the Fed manages to manipulate the Fed funds rate using an ample reserves framework. The cause and effect relationship between the quantitative easing program introduced by the Fed in response to the 2008 financial crisis / Great Recession and the exponential increase in the amount of reserves commercial banks now deposited at the Fed fundamentally altered the approach our nation's central bank uses to conduct monetary policy. No longer does the Fed operate under a limited reserves framework. Therefore, the old tools of monetary policy no longer work or apply. The Fed now operates under a framework of ample reserves. On this graph, the Fed funds rate, or central bank policy rate, is measured on the vertical axis. The horizontal axis measures the quantity of reserves demanded by commercial banks and the supply of reserves maintained by the Fed. In an ample reserves regime, the central bank maintains the supply of reserves in the horizontal range of the demand. On this graph, this is represented as any point to the right of point B. Remember, the traditional tool of monetary policy under a limited reserves framework was open market operations, or the buying or selling of government bonds. Notice on the graph, incremental increases in the supply caused by Fed purchases of government bonds, or a rightward shift of the supply from S1 to S2, or incremental decreases in the supply of money caused by the sale of government bonds. On this graph, a leftward shift of the supply from S1 to S3 no longer affect the Fed funds rate or impact the policy rate. Therefore, in the new regime or framework of ample reserves, the Fed changes the policy rate by raising or lowering the administered rates. This includes the discount rates and the interest on reserves. Raising or lowering the administered rates increases or decreases the amount of reserves banks demand. Observe the three segments of the demand for reserves curve, shaped like a Z. Remembering the policy rate, Fed funds rate, is measured on the vertical axis. The upper bound of the Fed funds rate is horizontal at the discount rate. The discount rate sets the upper bound for the Fed funds rate because it's the rate at which banks can borrow directly from the Fed's discount window as a backup source. No bank would pay a higher rate in the private Fed funds market than what the Fed offers. The discount rate acts as a ceiling on the Fed funds rate. The next segment of the demand for reserves is the familiar downward sloping segment. And then the demand for reserves turns horizontal again at the lower bound. The interest on reserves, or IOR, sets the lower bound or floor for the Fed funds rate because banks won't lend reserves overnight for less than they can earn risk-free by keeping those funds at the Fed. The Fed pays this rate, the interest on reserves, and by adjusting this interest rate it pays on reserves, the Fed steers the effective funds rate, the interbank lending rate, within their target range, making interest on reserves the new primary tool of monetary policy. The policy rate, or Fed funds rate, is found at equilibrium, or the intersection of the supply of reserves and the demand for reserves. The Fed still performs open market operations, or the buying and selling of government securities. The Fed performs open market operations to maintain ample reserves. But under an ample reserves regime, the Fed targets the policy rate by increasing or decreasing the administered rates. Changing the discount rate will affect the upper bound, but not directly impact the Fed funds policy rate. Remember, the primary tool used by the Fed to target the policy rate is interest on reserves. Changing interest on reserves moves the lower bound and changes the policy rate. Increasing interest on reserves shifts the lower bound upwards, increasing the policy rate, and decreasing interest on reserves shifts the lower bound downwards, decreasing the policy rate. It's currently December of 2025. The current target Fed funds rate is 3.75% to 4%. This means the Fed is currently paying 3.75% interest on reserves, setting the lower bound of the Fed funds target, and the discount rate is 4%, setting the upper bound of the Fed funds target. It is time to tie it all together to explain how the Fed implements monetary policy to address macroeconomic instability. Assume the economy is currently in a recession. On the aggregate demand, aggregate supply graph, current macroeconomic equilibrium at E1 denotes a recessionary gap characterized by contracting real GDP and cyclical unemployment. Observe the gap between YP, full employment level of output, and the current actual real GDP at Y1. How can monetary policy be used to address an economic downturn? An economic downturn or recessionary gap is characterized by contracting real GDP and cyclical unemployment with no upward pressure on aggregate price level. The Federal Reserve will attempt to alleviate this macroeconomic instability by implementing expansionary monetary policy. Under the old system of limited reserves, the tools of expansionary monetary policy included lowering the reserve requirement, lowering the discount rate. But the most important tool of monetary policy under limited reserves was open market operations, or increasing the money supply by purchasing government bonds. Expansionary monetary policy tools under ample reserves regime include the use of quantitative easing to increase or maintain ample reserves, forward guidance, or announcing to the economic community Fed intentions to lower its policy rates. But the primary tool of expansionary monetary policy under the system of ample reserves involves the Fed lowering interest on reserves. Observe the cause and effect of expansionary monetary policy. By lowering the interest on reserves, the Fed increases the money supply, putting downward pressure on interest rates. Lower interest rates encourage consumers to borrow and spend and spur gross business investment by improving the relationship between the expected return, the expected rate of return on capital expenditures relative to the now lower real rate of interest. Increases in consumer expenditures and gross business investment ultimately increase aggregate demand, which expands real GDP and reduces unemployment. The graph on the right illustrates the expansionary monetary policy effects of the Fed lowering interest on reserves, shifting the demand for reserves downward from IOR1 to IOR2. Reducing the interest rate on reserves lowers the Fed funds rate or policy rate. The money market graph on the left illustrates how expansionary monetary policy increases the money supply, causing interest rates to decrease, demonstrating how reducing the Fed funds rate ultimately impacts important interest rates in the economy, such as the interest rate on auto loans, mortgage interest rates, student loan interest rates, and the vitally important prime rate or rate at which businesses borrow. Reducing these interest rates increases consumer expenditures and gross business investment. Again, expansionary monetary policy in action. If the problem is a recession with contracting real GDP and cyclical unemployment, the Fed will use its tools under an ample reserves regime to lower the Fed funds rate by reducing interest on reserves, some quantitative easing, and some positive forward guidance. This will increase the money supply. The use of expansionary monetary policy leads to lower interest rates. Lower interest rates entice consumer and businesses to borrow and spend, which increases the C plus I component of GDP, ultimately shifting aggregate demand to the right and hopefully restoring full employment domestic output at macroeconomic equilibrium. As just explained, expansionary monetary policy increases the money supply, reducing interest rates. This effect is demonstrated in the money market graph on the left as a decrease in the interest rate from I1 to I2. The investment demand curve in the middle illustrates the relationship between interest rates and the expected return on investment or capital expenditures. Lower interest rates stimulate gross business investment as businesses now find more projects where the expected rate of return is greater than the now lower rate of interest. The effects of an increase in investment spending are illustrated on the aggregate demand, aggregate supply graph on the right. An increase in investment spending ultimately increases aggregate demand from AD1 to AD2. Recognizing the multiplier effect will contribute to the increase in aggregate demand. The expansionary monetary policy is successful in increasing real GDP and reducing unemployment. At the end of the academic day, it's most important to understand the big picture. If the economy is currently in a recession characterized by macroeconomic equilibrium at E1, Y1, P1, there's a recessionary gap with cyclical unemployment and contracting GDP. The ultimate goal of our central bank, the Federal Reserve, is to lower interest rates to stimulate consumer spending and gross business investment in an effort to shift aggregate demand back to the right towards full employment domestic output. Observe macroeconomic equilibrium at E1. Too much money chasing too few goods, spending outpacing the economy's ability to keep up with production. At Y1 level of output, actual real GDP is temporarily exceeding potential GDP, and the unemployment rate is below the natural rate of unemployment. However, at P1, inflation is well above the 2% Fed target, let's say 7 or 8%. How can the Federal Reserve alleviate Demand pull inflation. What is the proper monetary policy option to address an inflationary gap to help rein in the aggregate price level? The Federal Reserve will implement contractionary monetary policy to address the inflationary gap, which is characterized by expanding GDP, low unemployment, but inflation far above the 2% Fed target, say inflation of 7-8%. Under the old system of limited reserves, contractionary monetary policy options included raising the reserve requirement, raising the discount rate, and the most often used open market operations, selling government bonds to reduce the money supply. Under the new system of ample reserves, contractionary monetary policy involves the Fed selling government bonds or engaging in quantitative tightening, but making certain to maintain a system of ample reserves. The use of forward guidance, in essence, announcing the Fed's intentions to increase the policy rate. But it's important to understand the primary tool of monetary policy in an ample reserves regime is interest on reserves. The Fed will raise the interest it pays banks on reserves deposited at the Fed. Now observe the cause and effect relationship of contractionary monetary policy. Increasing the Fed funds rate will decrease the money supply. A reduction in the money supply will increase interest rates. At the now higher interest rates, it will be more costly for consumers to borrow and spend, and it will be more difficult for businesses to find projects where the expected rate of return is greater than the now higher real rate of interest. The reduction in consumer expenditures and gross business investments will decrease aggregate demand. A reduction in aggregate demand will cause real GDP to contract and ultimately rein in or reduce some of that inflation. The graph on the right illustrates the contractionary monetary policy effects of the Fed increasing interest on reserves, shifting the demand for reserves upward from IOR1 to IOR2, increasing the interest rate on reserves, increases the Fed funds rate or policy rate. The money market graph on the left illustrates how contractionary monetary policy decreases the money supply, causing interest rates to increase, demonstrating how increasing the Fed funds rate ultimately impacts important interest rates in the economy, such as the interest rate on auto loans, mortgage interest rates, student loan interest rates, credit card interest rates, and the vitally important prime rate of interest, or the interest rate at which businesses borrow. Now higher rates reduce consumer expenditures and gross business investment. Again, contractionary monetary policy in action. If the problem is an inflationary gap, aka demand pull inflation, characterized by expanding GDP, low unemployment, but inflation well above the Fed's 2% target, say 7%, under an ample reserves regime, the Fed will increase the Fed funds rate primarily by increasing interest on reserves. The Fed will likely use forward guidance, announcing to the economic community its intention of raising the policy rate. An increase in the Fed funds rate will reduce the money supply. A reduction in the money supply will increase interest rates. Higher interest rates will make it more costly for consumers to borrow and spend on automobiles and home loans. Higher interest rates will decrease gross business investment. A reduction in consumer expenditures and investment spending will decrease aggregate demand, ultimately shifting aggregate demand leftward by a multiplied amount, reducing GDP, and most importantly, bringing inflation back towards the 2% target. As just explained, contractionary monetary policy reduces the money supply, increasing interest rates. This effect is demonstrated on the money market graph on the left as an increase in the interest rate from I1 to I2. The investment demand curve in the center illustrates the relationship between interest rates and the expected rate of return on investment or capital expenditures. Higher interest rates stifle some gross business investment as firms find fewer projects where the expected rate of return is greater than the now higher rate of interest. The effects of a decrease in investment spending are illustrated on the aggregate demand, aggregate supply graph on the right. A decrease in investment spending ultimately decreases aggregate demand from AD1 to AD2, recognizing the multiplier effect will contribute to the decrease in aggregate demand. The contractionary monetary policy, if ultimately successful, reduces the aggregate price level or inflation. Ultimately, at the end of the academic day, it's most important to understand the big picture. Assume the economy is currently at macroeconomic equilibrium E1, Y1, PL1. Demand pull inflation, too much money chasing too few goods, an inflationary gap with strong real GDP, unemployment below the natural rate of unemployment, but inflation 7-8%. The ultimate goal of monetary policy, use contractionary monetary policy to rein in inflation. The Fed will increase its policy rate, the Fed funds rate, reducing the money supply, pushing up interest rates in the economy. Higher interest rates will make it more costly for consumers/households to borrow and spend. Higher interest rates will make it more challenging for businesses to find projects where the expected rate of return is greater than the now higher rate of interest. Ultimately, that will reduce aggregate demand, reining in some of that inflation, shifting AD from AD1 back towards full employment output at a lower price level, AD2, E2. This chart tracks the correlation between the Fed funds rate and the CPI consumer price index, tracking how the Fed changes the policy rate in response to changes in the CPI exemplifies how monetary policy works in practice. As predicted by economic theory, the Fed increases its policy rates whenever inflation, as measured by the consumer price index, begins to rise. Observe the significant increase in the Fed funds rate in response to the severe annual rates of inflation in the mid-70s, late 70s, and early 80s. Likewise, observe the significant drop in the Fed funds rate in the early 90s in response to a period of significant disinflation. Inflation remained extremely tame after the 2008 Great Recession, and again, as expected, the Fed funds rate was extremely low from 2009 through 2019. The federal government responded to the pandemic with excessive fiscal stimulus, causing demand pull inflation and an annual increase in the CPI of 9% in 2022. Again, as expected, in response to this inflationary environment, the Fed raised the Fed funds rate from a post-pandemic low of near 0% to over 5% in just over 12 months to combat the 9% inflation in 2022. It's important to evaluate the strengths and weaknesses of monetary policy. One of the principal advantages of monetary policy, especially relative to fiscal policy, is the speed and flexibility at which the central bank can act. Although the FOMC participates in scheduled meetings every 6 weeks or 8 times a year, the Fed can convene an emergency meeting whenever necessary. October 19th, 1987 is known as Black Monday. The Dow Jones Industrial Average fell by 22.6% in just one session. Immediately, the Fed convened an emergency meeting to institute a half percentage point decrease in the Fed funds rate to add liquidity and confidence to the economic system. The Fed acted in a similar manner in response to the radical Islamic terrorist attacks on 9/11. In addition to the speed at which monetary policy can be implemented, the magnitude is equally impressive. As already discussed, the Fed embarked on a mammoth program of quantitative easing to combat the 2008 Great Recession and implemented an even larger quantitative easing response to deal with the pandemic crisis. Most economists agree the unprecedented size of the monetary policy response to both of these events helped prevent economic Armageddon. Fed independence is another primary strength of monetary policy. Remember, the members of the Fed Board of Governors are not elected officials. Fed independence allows the U.S. Central Bank to institute unpopular but necessary contractionary monetary policy in response to inflation. Paul Volcker, the Fed chair in the early 80s, raised interest rates during a period of economic stagflation. This made Volcker one of the most hated individuals among business leaders. However, the short-term hatred gave way to long-term praise after the Fed successfully reined in double-digit inflation. The importance of Fed independence was again demonstrated when our nation's central bank raised interest rates to combat the 9% inflation that the economy experienced in 2022. It's absolutely necessary for the success of the Fed to act with independence, to institute necessary but most likely unpopular contractionary monetary policy. Monetary policy is not a perfect panacea. Like all things economics, there's a normative debate about increasing or decreasing the money supply to decrease or increase interest rates to influence economic activity. The first criticism of monetary policy is referred to as the operational lag. When the Fed lowers rates in response to an economic downturn, reduced borrowing costs do not make an immediate impact on the economy. It takes time for consumer borrowing and spending to influence the economy, and it may take even longer for businesses to alter investment plans and adjust capital expenditure projections. The same can be said for the delay in restrictive monetary policy, reducing consumer spending and gross business investment. Some critics of the Fed even suggest the operational lag translates to a significant delay on the impact of monetary policy, which actually translates to the ultimate result of monetary policy being counterproductive. Cyclical asymmetry is an interesting criticism of monetary policy. Economic history suggests that, that contractionary monetary policy implemented by the Fed is far more effective at reining in inflation than expansionary monetary policy is at stimulating consumer and investment spending during an economic downturn. The Fed can raise interest rates significantly, making it extremely challenging for consumers to borrow and spend, and seriously reducing the number of gross business investment projects where the expected rate of return is greater than the now higher rate of interest. But there's an old adage, you can lead a horse to water, but you can't make him drink. During a severe economic downturn, businesses may not be encouraged to borrow and invest in new projects, even at extremely low interest rates, when the economic outlook is miserable. Cyclical asymmetry suggests contractionary monetary policy is far more effective at reducing inflation than expansionary monetary policy is at stimulating aggregate demand to help the economy recover from a severe recession. A third criticism of monetary policy is referred to as the liquidity trap. A liquidity trap occurs when the Federal Reserve lowers interest rates to near zero, but instead of ultra low interest rates stimulating consumer spending and investment spending, households and businesses choose to hoard cash. This behavior renders the expansionary monetary policy largely ineffective. In the disinflationary environment, consumers choose to save, and businesses are reluctant to engage in market activities. Therefore, expansionary monetary policy doesn't really help the economy. Another interesting critique of monetary policy involves analyzing the unintended consequences of the Federal Reserve's new tool, quantitative easing. Theoretically, quantitative easing lowers interest rates to extremely low levels, enticing businesses to borrow and invest in new capital. However, many businesses chose to borrow and repurchase shares of their own stock. Stock repurchases and the extreme amount of liquidity injected into the system through quantitative easing incentivize investors to pile into equities. This chart demonstrates the unintended consequences of quantitative easing by tracking the correlation between the massive expansion of the Fed's balance sheet and the value of the S&P 500. The S&P 500 is a stock index that tracks the performance of the largest 500 corporations traded in the US stock market. The red line denotes the increases in the Fed's balance sheet resulting from quantitative easing. The blue line tracks the corresponding increases in the value of the S&P 500. As the Fed continued to purchase copious amounts of long-term government debt and mortgage-backed securities, pushing down interest rates on government bonds and other fixed instruments, stocks became relatively more attractive to investors. The massive amount of liquidity injected into the system by the Fed through its quantitative easing program resulted in a booming stock market. Although 62% of Americans own stock, either in their qualified retirement funds, 401k, 403b, or in a brokerage account, extremely wealthy Americans own a much higher percentage of equities. The significant increase in the stock market therefore benefited the wealthiest Americans most, expanding the income inequality in the United States. Quantitative easing was intended to support the economy overall and therefore create jobs for low and middle income earners. But the unintended consequence of this unique expansionary monetary policy tool was an even more pronounced disparity in income between wealthy Americans and average U.S. citizens. In some ways, quantitative easing was better for Wall Street than it was for Main Street. Another criticism of monetary policy is its ineffectiveness against supply side issues. Remember, monetary policy targets aggregate demand, spending, while supply shocks like energy crises or the pandemic disrupt actual production. This means tightening the money supply raises borrowing costs and slows the economy without fixing the underlying shortage, potentially worsening the problem. While contractionary monetary policy of raising rates can reduce demand, it can't magically create more oil, more computer chips, or shipping container, leading to a damaging combination of higher prices and lower output. There's a group of economists known as the monetarists. These economists, disciples of Milton Friedman and the Chicago School, advocate against the use of both fiscal and monetary policy. The monetarists argue the Fed does more harm than good. This famous quote by Milton Friedman sums up the monetarist position. Inflation is always and everywhere a monetary phenomena in the sense that it is and can be produced only by more rapid increase in the quantity of money than in output. Nobel Prize winning economist Milton Friedman wrote, and spoke extensively about the correlation between growth in the money supply and inflation during the 1970s and 1980s. This chart, which tracks the M2 money supply against the consumer price index, seems to support the monetarist's position, as increases in the blue M2 money supply line and in the mid 70s, late 70s, and early 80s resulted in double-digit inflation over those time frames. The final piece of this presentation involves introducing the velocity of money and the equation of exchange to explain the monetarist position. The velocity of money is simply the speed at which money circulates, the average number of times each dollar is spent on final goods and services in a year. Gross domestic product equals the quantity of goods and services produced annually multiplied by the price of those goods and services. But the equation of exchange demonstrates that GDP can be arrived at by multiplying the money supply by the velocity of money. With a little algebraic manipulation, it can be demonstrated that velocity equals P, the price level, times Q, the quantity of goods and services produced, over M, the money supply. Milton Friedman argued inflation is always and everywhere a monetary phenomenon. Therefore, increasing M, the money supply, increases P, the price level, causing inflation. The monetarists argued the Fed does more harm than good and is completely unnecessary. Their position is straightforward. The supply of money should be allowed to increase at a steady rate equal to the long-term rate of growth of production so that balanced growth can occur. For instance, if the long-term economic growth rate of the United States is 2.5%, simply grow the money supply at 2.5% to sustain full employment domestic output. Thank you for engaging in this economic lesson. Look forward to interacting with you in a future lesson.